We are very pleased to be here at the Federal Reserve Bank of Philadelphia, where Catherine Mann, a highly regarded and respected economist, a former endowed professor of international finance and economics from Brandeis University. She is now the chief economist at OECD, visiting us from Paris, and being with GIC to receive the very prestigious Hildring Award for global leadership. Catherine, we are very happy to have you with us, and this is an opportunity for me to ask you, being in academia for so many years and working in research and with the Federal Reserve and other organizations, what attracted you to become the chief economist at OECD to the point where you moved to Paris?
Well, first, I like to change the venue that I work with because, as you said, I worked for a while at the Federal Reserve. I then worked for a while at think tanks, Peterson Institute for International Economics in Washington, and I decided to become an academic for a while. And through those different places, I was always doing the same work in a sense, at international economics, but you had a different audience, you had different focus, developed a different network, and I think that's a great strength, and it's something that I really recommend people to do. Right. because you can take those new perspectives with you as you move through your career. And that's exactly what I did by going to the OECD. I even broadened my network out further to look at the issue of international economics and finance from the perspective of Europe, as opposed to from just the perspective of the United States.
And at this organization, which is an international organization, of course, there is a department of research, and you are involved with a lot of research activities and policy work. Can you just briefly share with us some of the work that has been concluded under your leadership there?
So the economics department has two branches. One is a research branch that looks at a range of questions on a cross-country basis, standard econometric cross-country basis. There is also a branch that evaluates policies and progress, economic growth, equity, employment, and so forth, for the countries, the members of the OECD, as well as key partners, Brazil, and the other in BRICS basically, as well as other countries. And so every 18 months, an extensive examination of the country is undertaken, which involves both research, often with data from statistical agencies in the country, but then discussed and presented to finance ministers, central bank governors, and employment ministries, if that's a focus, or a competition authority, if that's the focus. So that's a core aspect of what the OECD does, is take the research foundation and take it directly into a country.
I see. Since speaking of countries, of course, an interesting country during the summer that attracted everybody's attention was UK, England, where all of us from US and around the world, we observe the volatility in the market based on the announcement of the British exit vote. So can you share with us what is your perspective on the exchange rates and the volatility of those exchange rates during this period of time, and some predictions, if any, on the economic front and the financial markets front?
So we, in advance of the Brexit vote, the referendum, in April, we did an extensive report on evaluating possible outcomes for the UK economy, the European economies, and the global economy. And it had sort of two time horizons. One was the near-term time horizon from the vote up to 2020, and the effect on the UK economy and its neighborhood was principally through the channel of financial markets. And the expectation at the time was that we would see a big depreciation of the euro as the UK becoming more of a question mark about location for foreign direct investment became, if you were going to be out of the euro area, then
you have to, yes.
So somehow you have to make up that loss in competitiveness coming from no longer being part of a single market. And so we expected a depreciation of the sterling, and that's in fact what we saw. Now, we also expected there to be a risk premium put on sovereign bond interest rates. So we thought that those interest rates would go up. But now, of course, what actually happened was after the referendum, the Bank of England very rapidly responded with a dramatic change in the interest rate, a reduction in the interest rates, and additional effectively their version of quantitative easing, buying of sovereigns. And so rather than sovereign interest rates going up, sovereign interest rates fell. Now that also created momentum for a depreciation of the sterling. So that's the kind of the short-term effects and the volatility that came through the interest rate change, the Bank of England response, and then the exchange rate responding to the vote, and then to the Bank of England response. In that study, we also did a longer examination of the longer term, going out to 2030, where the biggest impact was on what would be the implication of the Brexit vote for investment, for migration, for trade, big question, and how would these percolate through to affect productivity growth? And of course, all of those are negative.
In the longer term.
In the longer term effect, yeah.
Unless something might change that we don't know.
Well, I mean, there's still a little bit of a question mark on the nature. I mean, there's a huge question mark on what the package will look like after exit. But there's still a question mark on exactly when exit will be. So what we did was try to parameterize as well as we could some scenarios, and then we haven't actually changed any of these medium-term scenarios because we don't have any more information now than we did back in April.
Correct. And speaking of Europe, of course, as we understand, the European Central Bank is involved in quantitative easing. The interest rates are very low, negative in certain financial assets. And then here in the U.S., we progressively see an environment, or we expect an environment of increasing interest rates. So if I may ask you, these differences in interest rates, of course, they move exchange rates, but there are two different channels. One is they impact the real economy, and they impact the financial assets. So can you give us some perspective and some perhaps analysis as to what we might anticipate in case where those interest rate differentials increase farther?
So we do think that we're looking at an environment where there is increasing interest rate differential between the U.S. and Europe, as the Federal Reserve is likely to raise interest rates at least modestly. And the European Central Bank has already said that they intend to continue on with their buying program at least for a while, and of course it goes through March 2017, and then we'll see after that. In some sense, the market has been expecting this, but the timing is uncertain. Is the Fed going to move in December? Is it not? Just a few days from now. And if there's a second move in the beginning of next year, when might it be? If we think about the longer term, like over a year or so, then it becomes very, very unclear as to what's going to happen to interest rate differentials. And so the question for an asset manager is, how soon do I rebalance my portfolio to a U.S. asset base or a European asset base? How soon do I do that? And there will be an exchange rate implication. And then, of course, I might have to rebalance again. So on the asset side, the point, I think, is to look for a lot of volatility, but around a tight range on the exchange rate, because it's uncertain. A variation that might have a bigger, more higher amplitude on the volatility is, what do we see coming in on growth rates? Does the U.S. growth rate really continue to be robust? And does Europe actually get weaker as it goes into the elections that they have next year?
And this is a big concern.
These are all the financial side things. Now, on the trade side, there are also issues in terms of the vocabulary of the trade agenda, how much movement there will be. We already know that TTIP is essentially off the table. So trade starts to look like something that has a life outside the exchange rates. There are many other factors that are affecting the extent to which trade and trade partnerships are maintained and continued, and that the normal thing where we say a depreciation of your currency enhances your market opportunities abroad, and so you export more. I think we're going to see a lot of that's less clear coming through over the next 2 years.
Does this apply also for trade between the United States and other economies, such as not only the Europeans, but China, for example? Is it...
That's a big concern.
Yes. Is it... there is also discussion about the the Chinese currency, the RMB, to what extent the currency is freely floated or it is manipulated. Right. Do you see that, given the dollar's value now and the expectations perhaps that it might be appreciated more, that this might impact trade flows with China?
So I think that first we have to recognize that the Chinese currency is not a freely floating currency, and we also have to pay attention to the RMB relative to its basket. We have a tendency to focus on the RMB dollar exchange rate. That's kind of an obvious one, but to the extent that what matters for the Chinese decision makers is the basket, RMB versus the basket. And in this environment that we are in today, where if the RMB dollar depreciates, the RMB euro is appreciating because the dollar, because of the way the dollar euro are working on each other. So that makes it challenging for the Chinese to manage their currency towards their objectives. So the issue that I am most concerned about when it comes to trade is that if the U.S. economy continues to do well, better than people think, and doing well, that of course tends to promote inflows, appreciating the dollar, general appreciation of the dollar, and the economy doing well is going to promote imports. And that's going to widen the U.S. current account deficit. And that is going to make the public demand or the public perception that something needs to be done on trade, to limit trade. That's going to increase the call for some sort of interventionist trade policy. And that, I think, is a big concern.
Are these imports that you outline in your potential scenario inflationary to the U.S. economy? Is there a possibility for those imports to be inflationary?
No,
given
if anything, it's the other way around, because when we think about what happens when the dollar appreciates, that means that the price of imports coming in are cheaper. And so, if anything, that puts a damper on inflation.
Prices.
And at a good time, in fact, because we do think that some of the real wage increases, which have been long overdue, that those real wage increases would tend to push up prices and boost inflation. At the same time, you've got imported intermediate prices pushing down inflation. So it actually puts the Federal Reserve in a good position because they don't have to worry about the inflationary implications of more robust growth.
So the last question is, current account deficits good or bad?
Current account deficits reflect the fact that the economy is robust and is bringing in imports. So to me, current account deficits are an indication of positive economic performance.
Okay. We want to thank you very much. We are very pleased to have Catherine Mann with us, and we wish you a great success in continuing your efforts working with OECD.
Thank you very much.